Good evening, participants. It is our pleasure to welcome you all to the webinar on Equity Market Insight by UTI Mutual Fund before we enter the new year 2025. This is our monthly series where we delve into updates on the global and domestic economic trends, market valuations, and our outlook, followed by an in-depth discussion on our fund's strategies. I'm Sonal Mittal, Product Specialist at UTI Mutual Fund. I'm joined by our Chief Investment Officer, Mr. Vetri Subramaniam, and Fund Manager, Mr. Ankit Agarwal, who manages UTI's Small Cap, Mid Cap, and Innovation Fund. Today, he will be talking about small cap and mid cap strategies. Post presentation, we will be taking up question and answers. Please note, you can keep posting your questions anytime during the webinar on the link provided to make the most of this opportunity. Without further ado, I will now hand over to Vetri. Over to you, Vetri. Thank you.
Good evening, Sonal. Good evening, everybody. Thank you for joining us here on this monthly edition of the Market Insight on Equity. And as Sonal has just reminded me as well, it is in fact our last webinar for 2024. Time does go by very, very quickly. But anyway, I will now kick into today's presentation where we'll cover most of our regular sort of big picture updates as well as the regular discussion on equities, earnings and valuations. And today, of course, on this call with me is Ankit Agarwal. He's one of our senior fund managers. He manages the mid-cap strategy, the small-cap strategy, and also manages our innovation strategy. So he's going to be talking about those strategies later. So without any further ado, we'll just dive into the first slide for today. Now, obviously, all of you are most probably very familiar with the GDP growth numbers that came out 2 weeks ago, which is why I don't actually have a slide on GDP growth, because everybody knows that number was sub 6%, and I know there were many eyebrows raised at that point. But in a way, it should not have come as too much of a surprise that growth was weak. Because commentary that we were getting from companies during the second quarter, and the earnings for most companies had already come through before the GDP estimate came out. So we already knew that the quarter was actually looking quite weak. And that is what eventually showed up in the GDP data. But very quickly, if you think more about what were the conditions that led to this 5.5% or so GDP print, I would argue that there was a significant contribution from both fiscal and monetary restraint. So on the left-hand side on this chart, what you have here is government spending, and this is the 12-month rolling fiscal deficit compared to 12 months ago. Now remember, India has embarked on a very, creditable trajectory of trying to control its fiscal deficit. Our target for FY26 is 4.5%, which would bring us back to where we were pre-pandemic in terms of the percentage fiscal deficit. Not too many countries around the world are, attempting this kind of, pull back in fiscal deficit to its pre-COVID trajectory. What that means is that the fiscal impulse, which means the quantum of fiscal deficit, which is increasing on an annual basis, is actually a contracting number. And that is why when you look at this, you'll see that when the pandemic hit into 19 and 20, the impact of the fiscal deficit was net positive on the economy because money was getting pushed out by way of government spending, tax revenues were lower. But into the compression, what we've already got is a very significant compression taking place. So it's not just monetary policy, which you can see on the right-hand side, which is, in a restrained mode. It's also fiscal spend, which is contributing to, weak growth. If you look at the right side, this shows you the real policy rate defined as the actual policy rate minus inflation. And what I would point to over here is, remember that when you look at core inflation, we are looking over here at the announced policy rate vis-a-vis the expectation of inflation for the full year, and that actually getting pulled higher by high food inflation. if you actually look at core inflation excluding food, remember it is running sub 4% for a considerable period of time. So excluding food, you could argue that the real policy rate is actually quite aggressive at this point of time. So to cut a long story short, if India's growth is weak, that is because both fiscal and monetary have been restraining the economy, and it reflects the thought process of policymakers to say that we are in an uncertain world. There are economic uncertainties, there are geopolitical uncertainties. Let us maintain macro stability so that if things go horribly wrong in geopolitics or in the economics, we have the headroom to be able to respond. So I think this just reflects that thought process. Moving on, I'll point to a second factor which is perhaps hampering growth. Now, remember that the banking system has been slowing down credit growth because they've been facing a challenge in terms of their own deposit growth, which means that they have to borrow the shortfall either from the RBI or from system liquidity. And with system liquidity being very tight, in effect, what has happened is that incremental credit growth has slowed down. So if you look at this number, go back to the start of the year, credit growth was running at 16% year on year. We've now dropped to 12.8%. And in fact, if I look at the latest available number, it's dropped to 11%. So the minute you have credit growth starting to slow dramatically, in the short term, there is no difference between somebody receiving income and somebody receiving credit, because credit gets spent in the economy. And therefore, as soon as you see credit growth slow, it does have an impact on economic growth as well. And on the right side, you can see credit growth divided into growth to agriculture, industry, services, and retail. And you can see that in both services and retail, there has been a significant compression in year-on-year growth. Some of this is also coming from regulatory intervention. Remember, it's almost more than a year since RBI started to raise risk weights in many unsecured and personal loan categories. And I think, as the data comes through, there's good reason to believe that RBI was on the right track to act preemptively. But having said that, acting preemptively and starting to reduce loan growth means it does slow down overall economic growth well. So that in a nutshell, looking at both fiscal restraint, monetary restraint, and credit growth, to my mind, sums up why growth has been slightly disappointing, along with some of the other factors you're familiar with, inflation, the monsoons, sort of being extreme in some cases, one quarter being impacted by the election. So these are all some of the factors which have contributed to this slowdown in reported growth. But quickly, let's jump to another track, because I know we typically talk a lot about valuations of India compared to its own history. But what we are putting up here today is how does India's valuation, and we are just using one measure of valuation, the simplest of them all, which is the price earnings ratio. How does India's P compare to the rest of the world? This is not the absolute P. The red line reflects India's premium to emerging markets. The black line refers to India's premium to the world. Now, as you can see, in October, November, as the market sold off, the black line drops, which is to say that India's premium to the rest of the world has come down. And if you look at the red line as well, of course, there is some reduction in the premium there, though the absolute level of premium relative to EMs is very, very high. But the simple more point I would make is that, the two sort of costliest markets in the world, one is the US market, the other is the Indian market, which is why India, in the EM comparison, the premium is massive. But because the US dominates the world index, it's almost 2/3 of the world index. Therefore, India's premium to that world composite looks much, much lower. And remember, the US market has continued to do quite well in October, November. So again, both those reasons are contributing to the reduction in premium. But the reason I'm putting this there is just to leave you with a broad point that for top-down asset allocators looking around the world to say, where are my opportunities? Which are the markets which are weak, which are giving me an opportunity, or which are the markets which are cheap or cheap related to the history, which is giving me an opportunity to buy into them? India has not ticked that box. It ticks many other boxes. It ticks the box in terms of its opportunity for long-term growth. It ticks the box in terms of its demographics. It ticks the box in terms of macroeconomic stability. So there are many boxes which get ticked for India, but the one which does not get ticked is the valuation box, and this is just a reflection of how our valuations stack up relative to the EM world and also relative to global equities. Moving on from that, we'll now jump back right into India. And what does the trajectory for earnings growth look like? The two yellow bars there at the right reflecting the current Bloomberg consensus expectations for March 25 and March 26. 8% earnings growth now expected in March 25 and about 14% in March 26. Now, if you go back about 6 months, you'll remember that the expectation was double-digit earnings growth in March 25. And one of the things I kept highlighting is that, it's not impossible, but because nominal revenue growth is low, because we have already seen significant margin, expansion in 2023, double-digit earnings growth is a very high bar to be achieved in 2025. I think those fears have come to roost, and we've now got a single-digit earnings growth expectation. On the next slide, what we've got here on the left-hand side is 4 bars. These show you the trajectory of earnings estimates for March 25. How have they behaved at the end of every quarter? So you can see from June 23 to December 23, there is a cut. Then it's sort of stable for 2 quarters, and in the most recent quarter, or rather in the last 6 months, there has been a cut of almost about 6 to 7% in about 6% in the earnings estimates for March 25. Similarly, if you look at FY26, as of now, the cut is only about 2.5 to 3%. But it just tells you that the cuts have been more pronounced in the last 2 to 3 months in particular. So we'll move on from this to look at what we always do, which is valuation. So on this slide, you've got the Nifty 50 trailing PE on the left-hand side. The white zone is the fair value zone. The yellow line is the average line. On a trailing basis, the Nifty 50 trailing PE is actually in the fair value zone. However, on a forward basis, it is much higher than the long-term average. The yellow line is at 16 times. We are now at 20.6, which is in fact more than one standard deviation above the long-term average. What does this look like on price to book? We can see that on the next slide. Wait for that to come up here. So you can see here that into the sell-off which took place in October, November, actually price to book for the Nifty 50 did drop down into the fairly valued zone. At month end with the recovery, it just barely sort of pushed back. But I would still say that when you look at large caps, really when I look at trailing PE, forward PE, trailing price to book, there is some reason to believe that large caps are, maybe in the upper reaches, but they're not expensive, they are not extravagantly valued. So that's certainly a message which comes through when you look at large caps. What about mid caps and small caps? Not much has changed here. You'll see that coming up on the next slide in terms of price to book. Remember the number about 3.7 for large caps. Massive premium on the mid caps. They're actually trading at 5.5 times trailing price to book, and the Nifty small cap trading at 4.2 times price to book. Very unusually, small caps now trading at a premium to the large caps, which I wouldn't normally expect, but it seems to have happened at this time. So again, we'll sum this up at the end, but large caps, I would say, in the fair value zone, even though in the upper end, but mid caps and small caps are where it's expensive. And of course, Ankit is going to be talking later about how is he navigating this challenging environment for mid caps and small caps. Jumping through to the next slide. We've normally put this slide up there, but I thought I'd spend a minute or two on this slide today. This is really a composite slide where we put together the forward price earnings ratio, the historical dividend yield, the price to book, and also the yield gap, which is the difference between the earnings yield of the Nifty and the 10-year bond yield. So in a way, this is a combined valuation indicator for equity. And we put this here as a broad guidance to investors. And depending on where the black line is, it tells you whether you're in fair value zone, whether you're in the zone where you should consider investing in equity through STPs, or is it in the green zone where you could either significantly increase the equity allocation when it is in the dark green zone, and certainly step up your allocation when it is in the lighter green equity allocation zone. Of course, very recently, this indicator was in the decreased equity allocation zone, but it's now actually dropped into that fair value zone. So in a way, this once again sort of picks up some of the stuff I talked about earlier, which is to say that when you look at the large cap, because remember this equity valuation index is based on the Nifty 50. So it really speaks to large caps and not to mid and small cap. And what this is telling you is that the large caps are somewhere in the fair value zone. They're not cheap. They're not in that green territory, but they're certainly not nosebleed expensive. And that's good news for investors. And that's why we are saying they can continue to allocate into equities. The black line tells you the current, tells you where the index is. The circle that you see there shows you the current level because the index is actually a 4-week average. So we've just shown you the chart, both including the actual index and the current value of that index. But again, not much of a difference. Both are in that fair value zone when you look at the composite. How to use this table is what I wanted to spend a minute on, and we've got that on the next slide. So when you respond to those categories, which we talked about, the red, orange, the white spaces, and then the light green and the dark green, what is the average 1-year forward return that investors in the Nifty have experienced when they invested in those zones? Those are the numbers that you see in the boxes. So the boxes are telling you that if you had entered the market in the decreased equity allocation zone, what would have been your average 1-year return? The average would have been 2%. If you enter in the fair value zone, which is a fairly large zone, your average return would have been 12%. If you enter in the dark green zone with a lump sum allocation, the average return is as high as 36%. Now, this is probabilistic because if you look at the distribution of the min and the max, which is the blue bars and the yellow bars, you'll see that in some cases, even when the market was in the decreased equity allocation zone, the best case return was actually plus 10%. Whereas in the increased equity allocation zone, even though it was light green, there is one situation in which your worst case return was actually minus 21%. So min and max do vary quite a bit, but the averages give you a good sense of what's the kind of outcome you can expect in that particular zone. I'll also draw your attention to the two rows at the bottom of the table because those are important as well. What is the probability that when you invest in the decreased equity allocation zone, you end up with a negative return over a 1-year period? That number is as high as 40% in that red colored zone of valuation. Move to the extreme right column of this table, the probability of getting a negative 1-year return when you are in that dark green zone drops to 0%. Means there has been no incidence of a 0% return when you invest when valuation indicator is in the dark green zone. And similarly, we've also plotted the probability of earning a return more than 12% in each of those zones. And as you can see, the more you move towards the dark green zone, the higher the probability that your return is about 12%. So this is probabilistic, and there is nothing in valuations which can give you a definitive answer. But probabilistic approach to investing is the way in which you can ensure that you can invest and align your likely outcomes to your financial goals. That is why we've presented this probabilistic template for you to be able to use. So very quickly, I'll just jump through to the final slide that I have, which is the summary. US economic data has continued to be quite healthy, and therefore expectations for US Fed policy rate cuts have moderated. People are now expecting on average about 3 rate cuts during 2025. Incidentally, that's exactly the number of rate cuts that we would expect in India as well over the next 6 to 9 months. The dollar has strengthened very significantly against all currencies, and this is because US growth relative to the rest of the world has remained much stronger. Plus, there is this expectation of higher import tariffs and also potentially looser fiscal policy. But we'll talk about that later. Perhaps something comes up in Q&A. In India, yes, growth has been challenged last quarter, but incrementally, both on the monetary side and on the fiscal side, we do expect incremental easing. Why? On the fiscal side, spending was very weak in the first and second quarter related to slow pace of decision making during election and immediate post-election period. But we think government will now certainly put the foot on the accelerator to get that spending going. So incrementally, the economy will experience a positive impulse rather than a negative impulse, which is on that chart. On the monetary policy side, as I said, the rate cut has already started, rather the CRR cut has already started to improve liquidity, which allows the system rate to move closer to the reverse repo rather than the repo rate. So in a way, it already starts to loosen system liquidity and system average overnight rates. We think the possibility of a rate cut in February is quite high. Therefore, again, incrementally, there will be more positive impact from monetary policy rather than a negative impact. So which is why we think incrementally, this quarter should most probably have been the worst in terms of GDP growth. We've already talked about earnings growth. We've talked about the fact that the mid cap and small cap are pricey compared to the large cap. So in this environment, really investors need to think more about asset allocation and risk management. Good news is that the large caps have certainly just about entered that fair value zone, so they're not blinking red anymore. But given where we are in the cycle and valuation, we still think that asset allocation is best achieved through hybrids. So the balanced advantage, multi-asset allocation, and equity savings funds are those that we would be biased toward for lump sum investments. In equities, continue with your staggered approach, but with a bias towards large caps, because that's in the fair value zone or upper reaches of fair value zone, unlike mid and small, which are pricey. And finally, year to date, the quality growth index is still slightly behind the benchmark, but in the last 6 months, it's actually outperforming the benchmark. And we think these are very early days in terms of an inflection towards quality growth and away from value, which has done very well over the last 3 years. And therefore, that's something that we are calling out as well, that we think there is an inflection the way the market is. So that's about it from my side in terms of the macro and broad perspectives. I'll now hand over to Ankit, and he'll talk in more detail about the mid-cap and cap strategy.
Yeah, thanks a lot, Vetri. And good evening, everyone. Welcome to this session on Equity Market Insight. As you know, I sort of manage the mid-cap and the small-cap strategies. And, I'll just run you through, how we manage, why we should invest in mid and small caps. And then at the end of the session, we can open the floor for Q&A. So just sort of let's take a step back and see, why one should look at this space and, what sort of handholding do investors really need over here. So I think one of the key points that we have made earlier is that mid and small provides you an opportunity to invest in some of the emerging sectors which may not be well represented in the large cap space, right? Today, you are seeing a lot of developments happening on the tech space. There are new, business models which are emerging, and a lot of these get represented largely in the mid and small. So actually, investments in the mid and small cap space actually opens up your investment horizon in some of these sectors which are still in that early stage of the growth cycle and not reached that stage of maturity yet. Next slide. The caveat there is, though, that a lot of these emerging sectors and stocks, etc., are very under researched and under owned, right? Because they have not reached that sort of maturity, and there's these small caps typically have very low analyst coverage and institutional ownership. And therefore, the amount of due diligence one needs to do in these names is much higher because you will not get an easy coverage on these companies. And that's why having an institutional framework to help you identify companies is very important, because that helps you select good quality businesses and weed out some of the poor quality ones, where maybe the mortality rates will be very high. I think this chart, the rolling returns on indices, further emphasizes the point that, especially in the small cap space, you can't just blindly invest in the index, right? I mean, if you look at the long-term performance of the small cap index, actually it is, much more inferior than even the mid cap index. and the standard deviation of rolling returns is much, much higher. And therefore, stock selection becomes quite important. In fact, our sense is that quality focus is very important as far as the small caps specifically are concerned. I think just to sort of recap a little bit on the our investment process, we follow what we call the score alpha process for all the strategies within UTI, which are based on two strong pillars. One is operating cash flow, and the second one is on return on capital employed. We put all the stocks which are within our coverage into three buckets: R1, R2, R3. R1 are companies which will have high ROCE, have more sort of consistency in performance. And C1, C2, C3 are more hygiene level factors where, you are looking for C1 companies which are high on operating cash flow generation. And you'd want to sort of be a little bit more careful with companies which do not generate operating cash flows on a consistent basis. So typically our growth quality strategy, you will see that will have a higher proportion of R1 businesses, while the ones which are more sort of value oriented will have a higher proportion of probably R2, R3 companies on a relative basis. Yeah. And, if you look at, and we did this sort of analysis on over long periods of time on companies, within that R1, R2, R3, and we saw that there could be times when R1 companies outperform, there could be times when R2, R3 companies outperform, and we have seen that R3 companies, which one would argue are the most, are the lowest in terms of ROCEs, they have done very well in the last 3-4 years. But we are seeing a trend of revival over there. And over the long term, over the last 15-year period, we have seen R1 companies sort of outperform. And especially in times of drawdowns, we have seen that R1 companies, they end up doing well. Now, just going back to the discussion where we saw that valuations in the mid and small cap space have become quite expensive. And, if earnings don't follow up, so basically that means that the expectations on earnings delivery is very high for the mid and small cap space. And if the companies within that space, they don't follow up, you could see, there is a risk of significant derating, drawdowns, etc. in that space. And that's what, we saw a bit in post the Q2 numbers, which in my mind, is one of the weakest quarters in terms of earnings growth that we have seen in the last many quarters. And I think that's what led to a bit of derating that we saw post the Q2 numbers. So I think the benchmark in terms of ability to beat the broader economy is much better with R1 companies, because they have good balance sheets and well run by good quality managements. And therefore, if at all we see some amount of slowdown in the economy, these companies, they tend to outperform. And therefore, having a backing on these high quality companies, especially in the mid and small cap space, could work in your favor in these times. And just sort of rounding out that point, that why focus on quality? Again, if you see in the mid cap index, actually, we have looked at this long-term analysis of when you look at the mid cap 100 index, almost 30% of the companies actually migrate to becoming large cap, 30% remain broadly mid caps, and 30% become small caps. But when I look at the small cap, indices, actually what happens there is very few, only 10 to 15% of companies end up becoming mid caps and then eventually large caps, right? So the mortality rate of companies in small caps is very high. Every now and then you will see some new companies emerging, but they don't sustain for long. And therefore, focusing on companies which have strength to be from a long-term perspective, I think gives you more durability to your portfolio. So I mean, I think that was from an India perspective. We also tried to very recently tried to understand okay, we have some analysis on Indian markets, but how have small and mid caps really behaved in global markets where you have much longer history, right? So we sort of said that let's look at the US market, which, and look at, say, last 30-year history over there. And, what we found very interestingly is that the trends that we have observed in India actually were present in the US market also. So what we did was we looked at ROC instead of putting them in three quartiles, we put them into five quartiles, and we saw that good quality businesses, which started as good quality, a large proportion of them continue to remain good quality businesses even 5 years down the line, right? And they generated much more consistent returns during that period. So when you combine them, the expected return from a good quality company, remains very high. So over long periods of time, we have seen that on an average, the probability of getting a decent return if you're holding a good quality business is very high as compared to other companies where you are expecting a turnaround to play out. So that's why our focus on the small and mid space has been on more quality oriented businesses, and they do well, especially during drawdowns, right? And therefore, through a cycle, these businesses end up doing well. And the proof of that, when we looked at, and we'll talk about this in the later part of the presentation, you'll see that, a strategy which does well during drawdowns, and even if it participates in an upturn, ends up doing well over sort of a long period of time. So that's broadly on the introduction. Just very quickly on the investment strategy, I think we have sort of highlighted a large percentage of our portfolio, almost 60 to 70%, is in scalable business models with a long runway of growth. And also, we sort of invest in businesses which are going through a transformation phase or maybe turnarounds going ahead. So very bottom-up focus in terms of investing, and true to label in terms of what we invest in these funds. So I mean, very just to sort of re-highlight, we are looking at companies which are market leaders, companies which have profitable volume growth, which have high returns on invested capital. And then, in turnarounds, we are looking at, again, companies which may be going through a tough macro at this point in time, but we expect that, these companies will re-rate as the macro for them improves. The broad framework is, we are looking at sort of, when we look at companies, we want to look at market leaders, companies which look like large caps, but maybe present in a mid and small cap space, purely because that sector may be still small. We're looking for companies which have strong governance standard, and we try to use various qualitative, quantitative checks to determine, how the quality of the management is. And then we focus a lot more on risk mitigation, and that's where focusing on R1 companies, style diversification, reducing idiosyncratic risk by keeping a more diversified portfolio. I think all that plays into reducing the volatility that you could expect in this space. Yeah, and therefore, once you do this, what we have seen is that especially in periods of drawdowns, the fund ends up doing much, much better. So, your fund performance pulls up during periods of drawdowns. And even if it sort of participates in the market over long periods of time, you will see this strategy doing well for you. Yeah, I think very quickly on the portfolio, again, very high focus on R1 companies. And therefore, in the small cap space, you will see that you have to pay a little bit more for quality. Therefore, the price to book and price to earnings number look high, but you get compensated for that in terms of high ROE and growth. When it comes to and when we look at sort of active weights and sectors, I think the way to think about it is that approach is a lot more stock specific. While you may use a top-down lens to look at sectors and maybe white spaces in your portfolio, but the approach is more about what stocks and companies can do well over the next 3 to 5 years, and what sort of alpha you can create in those. So it's a very, very bottom-up approach to investing as far as the small cap portfolio is concerned. On the mid cap side, again, it's a blend sort of a strategy which is a little bit with a growth quality bias. But again, you'll see a similar sort of characteristic where, your price to earnings will be on the slightly higher side. And here, it's managed in a very sort of a similar way to what we do in the small cap strategy. Although, because the universe here is limited, your ability to deviate significantly from that mid cap universe is much lower. And yeah, here also, the approach is largely bottoms up in nature. And here also the call is more on, which stocks and sectors will do well. Although you do put a more sort of top-down lens in terms of which, you from a risk management perspective, whether you're overexposed or underexposed to not only big sectors, but even to say some micro sectors. So just to summarize, both our strategies on the mid and small cap space are very true to label strategies with focus on scalable business models and long runway of growth. UTI, with its sort of vast experience in terms of research coverage, a large team is able to cover large cross section of companies, and therefore provides that institutional framework to sort of, as we have seen, since the mortality risk in that small cap space is high, is able to choose good quality businesses and avoid wealth destroyers. And then finally, our approach is, to make the portfolio in a way which does well during drawdowns. And therefore, we have a more diversified portfolio, which helps you to not only meet the liquidity risks in the portfolio, but also, you're not taking stock specific, very high stock specific risks. And therefore, for anyone who has a patient approach towards companies, and anyone who sort of is looking at a portfolio which will do well through cycles, can look at the mid and small cap strategies from a long-term perspective. I think that's it from my side. Sonal, it's back to you. And yeah, we can take questions now.
Thank you, Vetri and Ankit, for your insightful presentation. The webinar is now open for question and answers, and I invite all the participants to share the questions in link provided. While I wait for the questions to queue up, let me begin with the questions we have already received. Vetri, my first question is to you. Where do you see the transition happening in terms of where do you think there is a scope for underperformance in the next 12 months, and where do you think there is a scope for outperformance?
Having sectoral trends in terms of what will perform, will not perform is a bit of forecasting that I would claim I have no specific ability to do. What I have always believed and practiced is that you have the tailwinds of valuation behind you, and the returns will follow. Whether they follow in the next quarter or the next year or longer term period is harder to discern, but the probability is in your favor. Therefore, I think on the last few calls that we've done, I've continuously reiterated that the only sector where strong valuation support, reasonable, healthy fundamentals, therefore believe that there is good potential for absolute forward returns which are healthy is in the banking and financial services space.
Sure, Vetri. My next question is to you again. The GDP data hit a 7-quarter low. How does the macro picture look for investors? What are the macro growth factors for India in the coming years?
Sure. I think the broad picture that I would give you is that, look, India has the capability for all the things that we discussed earlier. All of that means that as an economy, we are well placed to grow 6 to 7% on an annualized basis per annum, the medium term outlook. But that doesn't mean that you will always be at a perfect 6.5 or a perfect 7 every quarter. There is cyclicality which is built even into structural trends. So we have talked I see some of those factors reversing. Those will certainly help, growth improve from this number in the days ahead. And if, for example, we were to see a much stronger global growth environment, because currently it's only the US, which is very, very strong in terms of its growth outlook. Europe is weak, China is weak. If, for example, we were to see a more synchronized global growth uptake, I believe that India would actually benefit from that by managing to go even slightly faster, because then the external economy would play a positive role in terms of growth. So those are the factors to watch out for. But as I said, one should not lose sight of the medium term potential, which is intact, but there will be smaller cycles.
Ankit, my next question is to you. We have come a long way in the small cap index where we saw corrections in the month of October. However, November seemed to flourish a bit. What is your view on this?
No, I think my sense is that this volatility probably in the index may continue. See, simply because today with the valuations being so high, there is already a lot of expectations built into the stocks and companies with, in terms of what is expected in future, right? And therefore, the benchmark in terms of what earnings delivery the market is expecting is very high, and therefore there is no room for error in some of these companies. And therefore, if you have a quarter like Q2 where earnings are disappointing and it's one of the weakest quarters, you will see these sort of drawdowns. My sense is that if quarter three also disappoints on earnings, while we have seen a recovery, you could see a similar sort of a drawdown. Now, the good thing is that because the liquidity in the market is fairly good, probably some of these corrections are possibly being bought into. But if the earnings don't follow, and which is the crucial bit, and because your benchmark benchmark in terms of valuations are set so high, I think that will continue to be a big risk in this mid and small cap space. And therefore, my suggestion to investors is that this is not possibly that easy period of returns where everything was moving up, is could possibly be behind us, because today it's all about if you are you in the right sector, stocks, a lot of the returns in the portfolios will be driven by stock specific actions rather than a more broad-based rally.
Sure, Ankit. Next question is again to you. Markets have been quite volatile in the last couple of months, particularly for small caps and mid caps. So, how are you positioning yourself in such kind of volatility, and which are those sectors or pockets where you are finding value amid such volatile markets?
Yeah, I mean, when we designed the strategy, especially when we launched the small cap strategy, nobody anticipated. We designed it in a way that that strategy does well through volatile times, right? And therefore, there was a lot more focus on quality. There was focus on businesses which are akin to large caps, but in the mid and small cap space, right? And therefore, a strategy like that ends up doing much better in a more volatile times, because that's where you see the benefit of quality playing out, right? In times when you see sort of slowdown in the economy, good quality companies, they end up doing much better because they have good balance sheets run by good management. Their ability to take market share is much higher. And therefore, that the positioning of our strategies, which is more sort of, while it is a blend strategy, but more sort of growth quality oriented, does sort of well during these times. And I think that's how we'll be looking at markets even going ahead, trying to sort of focus on quality franchises, which give you a visibility of growth and run by good quality managements, even going ahead. On the second question, in terms of which pockets we are seeing opportunity, I think there also I would say that it's going to be a little bit more stock specific question, because I think within a given sector you could see that there's some stocks which may be available at reasonably good valuations, and you would want to, back some of those businesses. I don't think, it's going to be, one broad brush across the whole sector, because in a given sector, you could find companies where valuation comfort is not there, and in some where valuation comfort is there. But I would say broadly, I think we're still okay with some opportunities in healthcare. We're still okay with opportunities on the private bank space. I think there is some amount of discretionary consumption making a comeback. Some amount in the in the T&D space, etc., or on the building material space is seeing some sort of revival. I think those are the areas where probably we are sort of positioned in.
Sure. Thanks, Ankit. Vetri, coming back to you. Our viewers are curious to understand your take on Trump 2.0 and what implications are going to be for emerging markets such as India.
Yeah. Sonal, what I would say is, look, there are things which are said when you are on election campaign, and then there is a question of how do you approach it when you actually start to implement policy. Yes, I mean, I think some of the broad parts of their toolkit certainly include tariffs, a desire to use tariffs to promote, manufacturing in the US, prevent large-scale imports from elsewhere, and to rebalance their own economy from consumption towards production. Not a bad, objective in itself, but it's a question of how do you go about it, and is the method in which you do it extremely disruptive? Are you planning to use limited tariffs or very extreme tariffs? So I think that is a global disruption that we run the risk of, particularly if the tariffs are very, very extreme. This would cause a change in the price level, but that does not necessarily amount to an inflationary trend. I think the other interesting thing to watch out for is the trajectory of the fiscal deficit, because remember, some of the Trump agenda calls for continuation of the existing tax breaks that were given 7 years ago, and further, certain more tax breaks are being proposed. This would mean that the US, which has not even considered reducing its fiscal deficit, it's still running at close to 6.5% fiscal deficit, might actually see its fiscal deficit expand further in the near future. That is certainly not good news in an economy where debt to GDP is already 122, 125%. So, I would have to worry about the sustainability of such a policy. Now, add on top of that the so-called Department of Governmental Efficiency, which claims it will cut $2 trillion of costs, except there's a slight problem. They've not talked about cutting $2 trillion of expenditure every year. They've just talked about it as an aggregate number. So we really don't know what the cut would amount to on an annual basis. Secondly, if you break down the fiscal expenditure of the US government into what they cannot not spend on, things like healthcare, Medicaid, the essential defense expenditure, interest payments to the people who hold their bonds, then the total quantum of discretionary expenditure every year is less than 1.5 trillion, out of which half of which is defense expenditure. So you can't build a muscular state by cutting your defense expenditure. So exactly where will you find this 2 trillion? Is this a number that you will find over many years? And secondly, sequencing matters. Tax cuts have an immediate impact of increasing the deficit, whereas in the long term, some of these expense reductions might help. But can they really get to those big numbers is the question. And secondly, we don't know what will eventually get implemented. If you look at the likely candidate for Treasury Secretary, he talks about, or at least in an article he wrote in the Wall Street Journal, he talked about 333, which is 3% growth for the US, which is certainly a objective that all of us would be very happy with. But he's talked about a fiscal deficit of 3%. How do you get to 3% if you plan to first cut taxes? And you'll require some very dramatic expenditure cuts when it's not visible that there is scope to cut expenditure that dramatically in the near term. So I think there are some inherent contradictions in some of these, and we'll just have to wait and watch and just get set for a lot more policy volatility. And we can only hope that whatever is done more from a bargaining position and no overnight extreme steps are taken in terms of policy.
Thanks, Vetri. Ankit, coming to you. How do you manage risks such as liquidity risk while aiming for alpha in the small cap and mid cap funds?
Yeah, so I mean, I think liquidity risk has also been highlighted, multiple times by the regulator, and therefore, when we designed the strategy, we wanted it to be a little bit more diversified so that we are able to scale it up to a much higher AUM, and therefore, if you see, we do manage with fair amount of diversification in the portfolio. But it doesn't take away from ability to generate alpha, because then your active shares continue to remain fairly high. So that's our whole take, that you do not want to be one overexposed to a given sector and one particular stock. Secondly, liquidity is becomes tight especially in times when there is more volatility in the market, and therefore one has to be cognizant about that when you're building a position in a particular stock. So we do take care of these things, but we do manage, the return potential gets managed by, keeping a reasonable active share in what we hold in a portfolio.
Vetri, my next question is to you. We have seen a couple of false starts earlier from China. They came out with stimulus 1.0, 2.0, which did not really work out the way expected. Now, additional measures are coming in. What are the chances that this too might just fizzle out and not being able to increase the demand in a big way? What is your base case scenario right now?
Just two things I'd like to point over here. Sunil. I think when we bring the perspective of, oh my God, if the Chinese equity market does well, it's bad for India, I think we are missing the bigger picture. Please remember, the US is a $30 trillion economy, China is a $20 trillion economy, we are a $5 trillion economy, right? I mean, a $4 trillion economy. For us to grow and achieve our global aspirations of stronger growth, we are better off if the global economy is strong rather than if the global economy is weak. So the Indian economy, to my mind, would be better off if the Chinese economy were doing well rather than if the Chinese economy is struggling. I think it's a very short-sighted view of the world to say, oh my God, we don't want Chinese equities to do well because that means our equities will not do well. Well, eventually, if growth is good, earnings are growth, market will take care of themselves. So, that's one part of the argument. Second part, very specifically to your question, Sonal, I do sense that for the first time, Chinese authorities are starting to respond to the fact that, maybe they've achieved a kind of slowdown and at least they've sort of dampened the problem of an overheated property sector in the Chinese economy. And therefore, they are trying to put a floor under their economic growth. Now, whether they will be successful is a matter of, conjecture at this point of time. We can't really be certain. But, I would say from my own experience, going back to certainly the example of the US during the dot-com crisis in 2001, when, Alan Greenspan famously took down rates, and then again in the post-GFC period in US, that when policymakers set their sight on doing whatever is necessary, as European Central Bank, chair Mario Draghi very famously said in 2011, when people were worried that the EU would break up, he said, we will do whatever it takes. So when policymakers take the approach of we will do whatever it takes, there is a fundamental shift that starts to take place. We can argue about will it take 2 quarters or 6 quarters, but I do think this is a very significant change in policy stance, and one should not ignore that reality.
Thank you, Vetri. In the interest of time, I will take 2 more questions. Ankit, my next question is to you. Why are consistent or high returns on invested capital such an important factor for your analysis of small and mid-cap companies?
So, one should think about ROIC as a fuel for growth in a way, right? So, I mean, how does a company grow? If you just go back to the basics of it all, you invest in plant and machinery, you have to put money in buying raw materials, then you create a product, and then once you sell it, you generate profit, and that profit after, you pay your vendors, etc., is, the cash flow that you have is the money that you can use to reinvest in this business, right? Now, think of a company which has, say, 100 rupees of capital it requires to, say, buy a particular equipment, and it generates 20 rupees of profits, right? So its ROCE is 20%. Now, for this company to buy another machine will take, say, 5 years, right? Because I'll take 20 rupees every year, assuming it's a no growth business, I'll take 5 years. Think of another company which has, 100 rupees of equipment we bought, and it generates 50 rupees of profit, right? Now, the ROC of that company is 50%, but it will take just 2 years for me to buy a new machine, right? So in a way, ROCE, one can think about it as it is a capacity that the business has to grow, right? And it comes, and high ROCs, you will only be able to earn for a you're doing something differentiated from what, something which the others can't copy easily. Otherwise, all the other companies will come in and your ROCs will come down over a period of time. Therefore, companies which are over a period of time are able to demonstrate high ROCE is a reflection of the quality of the business that they have created, which others can't possibly come in and easily break that, what we call moat in very common terms, is the competitive advantage that that company has created. And therefore, it becomes very important for, for a company, because since you're investing in that company to grow, the ability to reinvest in that business and continuously grow depends on, the return on capital that company generates. Otherwise, you'll have to continuously either go to capital markets, raise equity to fund your growth, or go to banks and, raise debt to grow your, which is never sustainable in the long term. So that's why we look at ROICs to determine, what is it different that this company is doing. Actually, ROC is a reflection of all that, and it gives you comfort that the business can go sustainably over a period of time.
Thank you, Ankit. Vetri, my last question for today's webinar is to you. The year is ending in a few days. Do you think FII selling is done now and market will bounce back by the end of calendar year? What are the chances of Santa rally this time?
Good question, Sonal. Well, Christmas will come on December 25th. I have no clue whether FPIs will come or not. I've been in this market for 30 years, and what I can tell you is nobody has successfully forecasted when foreigners will buy or sell. And therefore, I have always believed that my training as an analyst only trained me to analyze fundamental data about companies and not really to try and forecast what flows would be. So I'll stick to the fundamentals. When they are right is when I'm happy to buy. When the valuations are right is when I'm happy to buy. I'm not an expert on flows. Maybe somebody else is, but I'm happy to pass on that.
Thank you, Vetri. On behalf of UTI Mutual Fund, I extend our sincere gratitude to all the viewers. We hope you found today's session enriching and insightful. I would like to thank our esteemed speaker, Mr. Vetri Subramaniam, and Mr. Ankit Agarwal for sharing valuable insights and addressing the questions. Please do share your feedback on the link provided. With this, we conclude today's session. Thank you. Good day.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.